During times of economic instability, it may be difficult to commit to a major purchase like a home. Even in times of economic certainty, it may seem like the bottom is about to fall out, and you don't want your property to be collateral damage. Although national property prices have been falling since the middle of 2022 due to rising interest rates, analysts agree that a quick and dramatic collapse is very much possible given the present market circumstances. Factors such as demand, supply, mortgage rates, and unemployment all play a role in determining the health of the real estate market. And these indicators currently point to a period of decline in some markets and growth in others, but a decline in transactions overall. You need to know about the current state of the housing market and the signs which indicate whether or not a collapse is coming. So is there a bubble in the property market? When compared to the housing market collapse of 2008, what has changed? To what extent does a downturn in the economy influence home prices? And under what circumstances may the housing market collapse? All answers are given in this video, so be sure to stick with us till the end. Real estate bubbles are periods of unusually high price growth, as described by economics. Quick market value increase correctly reflects the housing market up until around halfway through 2022, given the rapid speed of the market that has lasted nearly the duration of the COVID-19 pandemic. According to Redfin's data on house sales prices, annual home price rise was in the double digits every month from August 2020 through the middle of July 2022. However, there are now fewer indicators of a bursting housing bubble. Since the summer of 2022, prices have fallen every month on average. Along with this, Redfin also reports that while property prices are up year over year as of December, they are just 1.8% higher than they were in December 2021. Philadelphia-based wealth management company Glenmead's Vice President of Investment Strategy, Mike Reynolds, believes that current housing values are a touch overextended, nonetheless, relative to what they should be given current mortgage interest rates. Although mortgage rates are not directly tied to the federal funds target rate established by the Fed, it is common for mortgage rates to rise or fall in response to the Fed's activities. To combat rising prices, the federal funds target rate has been increased many times during the last 12 months. According to Freddie Mac, the average interest rate on a 30-year fixed-rate mortgage peaked at over 7% in October and November 2022. But as of January 26 of this year, it has fallen to 6.13%. Even if mortgage rates have dropped marginally in 2023, it seems that many would-be buyers are still waiting on the sidelines since high property prices make homeownership unaffordable. Even before the epidemic, a lack of available properties was a big factor in the rapid appreciation of property values. But that trend has continued as builders shelve expansion plans and sellers hold off on making any moves. Eventually, low demand will cause house prices to fall year over year, but it won't necessarily lead to a housing market crash. According to Reynolds' best guess, the housing market will eventually stabilize and prices will once again reflect what buyers can realistically pay. Even if some air is let out of this bubble, as Reynolds puts it, an entire explosion is improbable this time around. It's still conceivable. Prices can decline without a crash. The decline in house sales has been dramatic. Redfin reports show that December house sales were roughly 37% lower than December 2002 sales. A dip in property values may not be as worrying as it otherwise would be since homeowners now have the means to wait through economic uncertainty and rising interest rates. According to Jörg Kessler, CEO of EasyKnock, a firm that offers an alternative to home equity loans, markets that witnessed higher house price increase in recent years are more likely to suffer larger declines as prices adjust to meet with long-term demand. Austin, Nashville, Miami, and Phoenix are among the cities where he anticipates a 10% or more price drop since they saw rapid price appreciation. As a result of the sharp price increase, many of those sites had a lot of institutional purchasers, and they have pulled back now, Kessler explains. Many of the most popular real estate areas have seen a slowdown in activity from iBuyers or real estate speculators seeking to make a quick profit by purchasing and reselling single-family homes. The 2008 crash and now. When the economy is unstable, buying a home may be terrifying, particularly if you remember the Great Recession and the meltdown of the property market in 2008, and 2009. Many homeowners in the initial years of the new millennium experienced bankruptcy as a result of predatory lending practices as adjustable interest rates climbed, and the number of foreclosed homes grew even more when the unemployment rate rose. Mortgages were given to individuals who weren't in a strong position financially to purchase and maintain a property, artificially boosting housing demand at a time when buyer demand was already falling due to the economic downturn. The outcome was a precipitous fall in home prices. Executive VP of Market Intelligence at Irvine, California-based real estate data business Adam, Rick Sharga, believes the present scenario is substantially different from the Great Recession. He argues mortgage delinquency rates are actually lower than they were previous to COVID, adding that 2019 was, historically speaking, a rather quiet year for foreclosure activity. 93% of borrowers who are in foreclosure right now really have positive equity in their houses, Sharga adds. This offers these troubled homeowners a few different possibilities for a soft landing. According to Reynolds, the supply problem is a key distinction between the current market and the one that preceded the housing meltdown in 2008. He explains that before 2008, the market was oversaturated with new homes, such that when demand increases, whole housing projects stood empty. Since the Great Recession, the construction of new homes has lagged behind the pace at which new households have been formed. In contrast to the 1960s, there are fewer residences per family now. As Reynolds puts it, now many rules and legislations have protected today's homeowners against fraudulent practices. More eligible buyers are looking for houses than there are properties for sale. And this is true despite the fact that high housing prices and increasing interest rates have made homeownership unattainable for many who would otherwise be interested in purchasing a home. All of these things taken together, adds Reynolds, have led to the consensus that a collapse at this moment is improbable. Impact of a recession on the housing market. A recession is defined as at least 2 consecutive quarters of negative GDP growth, and it is often accompanied by a rise in unemployment and a reduction in consumer spending. Home buyers may delay their search for fear of layoffs, and there may be a minor uptick in foreclosure activity as rising unemployment raises the number of those who can't pay their mortgage. However, after housing market activity slows down enough, mortgage interest rates decrease to a point where buyers join the market again, eager to receive a good bargain. An increase in housing market activity, unlike during the Great Recession, aids in pulling the economy out of a downturn. According to data from the Bureau of Economic Analysis, real GDP grew in the last 2 quarters of 2022 by 3.2% in the third quarter and 2.9% in the fourth quarter. The Bureau of Labor Statistics reports that unemployment remained at a historically low 3.5% in December. While these metrics do not point to a recession at this time, most analysts think that a downturn is expected by 2023 due to the Federal Reserve's policies during 2022. Although Kessler predicts a brief economic downturn, he is certain that one will occur. That's all for today. If you liked this video, make sure to hit that like button. Subscribe to the channel and press the bell icon for any new updates. See you in the next one.